The catalyst for the sell-off today was the Fed. And you had kind of like a 1-2 punch to the gold and silver market from the Fed, because first you got some statements that were made by a Fed official. And I forget, again, the traders who are selling gold and silver still don't understand why the prices are rising in the first place. It doesn't matter when the Fed cuts rates. It doesn't even matter if they do cut rates. They never have to cut rates. The Fed could relieve rates right where they are, and gold and silver prices should skyrocket. Why is that? Because they're too low. The Fed aborted the hiking campaign too soon. And so it doesn't matter if they cut rates. Sure, if they cut rates, maybe gold and silver will go up a little quicker, but they're going to go up no matter what. Because the one thing we know is that the Fed is not going to raise rates.
Silver prices recently soared to an 11-year high of $32.63 an ounce on Tuesday, the highest level since December 2012. However, later that same day, prices dropped to around $32.05 an ounce. This compares to Monday's trading range, which saw prices fluctuate between $31.10 and $32.48 an ounce. Silver's price movements largely mirrored gold, which reached a new all-time high on Monday before experiencing a slight decline on Tuesday. The Silver Institute has forecasted a structural supply deficit for the fourth consecutive year, indicating a supportive environment for higher silver prices. According to famous analyst Peter Schiff, gold's recent surge past $2,400 an ounce is a positive indicator for silver, effectively giving it the momentum to break through its resistance levels. Earlier this year, the gold-silver price ratio climbed to over 90, suggesting that silver was significantly undervalued compared to gold. This set the stage for a potential rise in silver prices, and indeed, recent gains have brought the gold-silver ratio down to around 76 as of Tuesday. Actions from the Federal Reserve triggered the recent sell-off in both gold and silver. Peter observes that there were two main catalysts. First, a Fed official made statements on CNBC, and later, the release of the FOMC minutes. The Fed official indicated that rate cuts might not begin until later in the year. If the rate cuts start late, there may only be one in 2024, with more cuts possibly occurring in 2025. This news led to an immediate sell-off in the gold and silver markets. The recent price correction is viewed as a short-term fluctuation within a longer-term upward trend. Peter suggests that both gold and silver offer promising opportunities, but silver in particular stands out due to its current undervaluation and strong prospects. Now, we present you the clips of Peter Schiff's insights. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
That they should buy more silver than gold because gold kept going up and silver wasn't. And I guess that the reason for that was that central banks were the primary buyers of gold and that they weren't buying silver. And since the general public has been selling, in fact, we've had 11 consecutive monthly outflows out of gold ETFs, indicating that investors in the US, also in Europe, have been selling, even though the price has been rising. So somebody must be buying enough gold to offset all this retail investor selling. And a lot of that is central banks. And they don't buy silver. They don't have room for silver. They're buying gold. And so I thought that silver was kind of getting left out, but that eventually, like a coiled spring, it would explode. And I kept saying, buy silver, buy silver. It's got to go up. There's no way gold's going to keep rising and it's going to leave silver behind. In fact, I know that in a real bull market, which I believe we're in, silver could lead gold. And so it's been lagging. And so I wanted my audience to buy it before it jumped ahead. Well, now it had that breakout. And so I did that special video on Thursday to alert people to this breakout, to get them to go and buy some silver on that breakout. We've had a nice 2-day correction in price following that breakout and move to new highs. Most of the decline was today, although we had some of the decline yesterday. So I mentioned that silver got all the way up to $32.50, which is still low. It's not like that's a high price. It's just the highest it's been since 2013. But as I'm recording this podcast on Wednesday night, silver is back down at $30.73. So that's a pretty substantial pullback, about a dollar, what, 80 or so from the 32.50 that it traded on Monday. And if 30 is now the support, which I think it is, now that doesn't mean silver can't go below 30, but I think 30 is to silver what 2000 was to gold. Once we broke above 2000, 2000 became support. And yes, every once in a while we dip below 2000, but we never stayed below it for long, and it quickly came back. So I don't know if silver is going to go back below 30,000. I mean, 30. It might go below 30, but I don't think it'll stay below 30 for very long. And at $30.67, that's close enough to 30 not to worry about it. I would buy it. On gold, gold is now about $70 off the high of 24.50. It's at 23.77. I think the support in gold is moving higher. So it was 2,200. Now it's probably 2,300, maybe even a little better. So I don't think you're going to get much bigger pullbacks than what we've just seen in the last couple of days. But I wanted to reiterate that this is an opportunity to buy both metals, but in particular silver. And the catalyst for the sell-off today was the Fed. And you had kind of like a 1-2 punch to the gold and silver market from the Fed, because first you got some statements that were made by a Fed official, and I forget who it was. I mean, I guess it's immaterial, because you could just switch them around because they don't really say anything any different. But one of them was on CNBC, and he had an interview. And then later on in the day, we got the minutes, the FOMC minutes that were released. So that was the second punch. The first one was the interview. And during this interview, the guy said that the rate cuts that are coming, right? The Fed is still talking about how these rate cuts are coming. But he mentioned that they're probably not going to start until later in the year. And that if they start later in the year, there may only be one, right? Because they may start the rate cuts so late that only one of them happens in 2024. And so we get the other rate cuts in 2025. So as soon as those words came out of this guy's mouth, gold and silver immediately sold off.
Regarding government statistics, Peter Schiff argues that metrics like CPI and GDP don't reflect true economic growth or inflation, which he believes is driven by money supply expansion. He expresses that leisure, highly valued by Americans, needs to be accounted for in GDP, affecting well-being assessments. Moreover, Schiff predicts persistent inflation will erode productivity gains, making gold and silver more attractive investments. While precious metals uphold a reputation as a hedge against inflation, gold and silver do not follow exactly the same price patterns. In fact, gold is a better hedge against inflation since the traditional demand much less influences it in industrial applications. Studies have found that gold may be an effective way to defend your wealth against inflation, but only over extremely long periods, measured in decades or even centuries. A 2022 insight paper from WisdomTree, looking at the investment case for gold, described the precious metal as an excellent store of value. Let's get back to the interview.
None of these government numbers, whether it's the CPI or the PCE or the GDP deflator, none of these numbers tell the real story about how much prices are actually going up. And so none of them mean anything. And they certainly don't mean that we have a growing economy. Yes, we have an increase in the GDP. A lot of stuff can increase in GDP. That doesn't necessarily mean the economy improved. You have a big hurricane, does a lot of damage. You got to spend a lot of money fixing what broke. All that goes into the GDP, but we would have been better off without the hurricane and without all that broken stuff that we had to fix. Leisure counts as zero in the GDP. What is something that Americans desire most? And that's free time. That's leisure. I mean, why do you think people long to retire? Why is retirement a goal? Because when you retire, you have more leisure. You don't have to work anymore. You can relax, right? So Americans value leisure, free time. But there's no value to the GDP of that, right? If I just lie around on the beach that doesn't generate any GDP, right? The government would rather have me working where that goes into the GDP than have me relaxing when that doesn't go into the GDP. But my overall well-being, my overall standard of living may be higher. I may enjoy my life more if I could relax more, if I had more leisure. But that doesn't really accurately get reflected in the GDP. But the point I wanted to make when I initially started this conversation was the Fed was putting in those minutes that maybe, because they say the economy is really good and they were worried about, oh, well, we might get inflation. Maybe we won't, right? They're saying maybe we don't have to worry. Even though we have this great economy, we don't have to worry about this great economy causing inflation because of the productivity enhancements that are going to diminish that inflation. But those productivity enhancements don't diminish the inflation. They just diminish the price increases. The inflation is the expansion of the money supply. And the government's going to keep expanding the money supply because they got no choice. I mean, so they're going to keep on creating inflation. And that means they're going to keep on robbing from the public any benefits that might otherwise have come their way through increases in productivity. And that is the economic reality. That's why this gold and silver rally is just getting started. And you want to buy any opportunity, any pullback. And again, I think they're going to be short and shallow because the real money, the big movement into gold and silver is underway. Gold didn't make an all-time record high for no reason, right? This is not an insignificant event that you want to dismiss. Neither is the breakout. Neither is that move to almost 2,500 on the price of gold without any fanfare. Nobody's talking about it. No one's paying attention to it. What are they paying attention to? Oh, now Ethereum is going to get an ETF. Yeah, that's the big news, right? That's obscuring what's going on in precious metals. Silver hitting the highest price since 2013 is a significant monetary event.
However, short-term challenges such as a slowdown in the Chinese economy and reduced likelihood of U.S. interest rate cuts could hinder silver's institutional investment. Nevertheless, market analysts expect a turnaround in the second half of 2024, aligning with potential Federal Reserve rate cuts, which historically boost precious metal prices. What are your thoughts on the future of gold and silver as investments in the face of ongoing economic challenges and inflationary pressures? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.